A breakdown of the results today.
Yeah, so Morgan Stanley came out as our last bank for the six that we cover, and the results were really good. I mean, they were rather amazing, actually, in investment banking. The fees there just surpassed all expectations on a number of fronts. The advisory revenues were really good, but also you saw a lot of good deals in the ECM side, which is basically where you see the new stock deals. So it was all great, and even on the wealth management side, which is essentially half of Morgan Stanley's business now, things were also really robust, and they're keeping some of their advisor attrition, those financial advisors that kind of move around to different firms, that's also been very low. So really a good quarter for Morgan Stanley.
Yeah, Laura, you were talking about that theme of what we learned on the conference call about the wealth management side of the business today. What does it tell us about competition in that part of their business right now?
Yeah, I mean, this has been a theme among what we call the big wirehouses. So, that's Merrill Lynch included, Wells Fargo, UBS too. And what they're essentially talking about is there's really not as much movement happening with these financial advisors because they're not recruiting, internally from those four different banks. And that's actually very helpful because the bank then does not have to pay as much compensation because there isn't as much competition for those folks.
And we were talking about the yield curve just earlier and what Chairman Powell was saying today. If we bring the yield curve into the conversation, into banks, this chart on the GTV Go library just showing you that both regional and major U.S. banks have been following the 6-month and 5-year curve. That would be the line in yellow right there. How much concern have we heard from banks about their outlook given the flattening yield curve?
That's very interesting, Sherry, because they actually haven't talked about that as much of a theme. It was less of a theme than you would have thought before going into the quarter, because obviously the yield curve has not cooperated in the way that banks want to see it. And some of the executives actually said, well, look, I'm not really looking so much at the 10-year anymore as where I'm going to be up for or down for net interest income. So it's kind of interesting. They're putting you off a little bit in terms of how you look at them. So maybe not the best thing, but at the same time, we know, of course, the yield curve is quite important to these banks. And I want to say, too, the consumer front for them, thinking about the yield curve, has been very helpful. Most of our banks were able to increase loans this quarter, with the exception of Wells Fargo, where it actually fell by $7 billion. Remember, they have that Fed asset cap in place, so that's kind of what happened with them. But the consumer really is helping a lot of these banks this quarter, and that's also being buttressed as well by the company side, borrowing more money, and also these big deal fronts, which is why we saw investment banking, gosh, it was $8.7 billion of revenue for our 5 banks. I've never seen that before. Even pre-crisis, you didn't match that.
Oh, wow.
And Laura, real quickly before you go, I would imagine this market turmoil bodes well for the Wall Street firms if it continues.
Yes, every trader likes a little bit of volatility, maybe not too much, but definitely some. And you are seeing that the June month was really what helped a lot of these banks in the trading revenue. Most of the executives, when we talked with them at different conferences, when they're interviewed, they had actually forecast a pretty flat and rather boring trading quarter. And that's not what happened. We ended up, I was looking at the numbers earlier here, and advancing 9% overall in trading, mostly driven by the trading in stocks, which was up a little bit more than the fixed income. So definitely not a boring quarter whatsoever on the trading side.